Welcome to your Mortgage Insider Weekend Wrap Update. Today, Friday, August the 2nd, unemployment ticks up and the stock market does not like it. The bond market, mortgages, mortgage-backed securities, basically anything related to interest rates is betting that the Federal Reserve will cut the rates almost positively a quarter basis point in September. They passed on that and they're meeting this week. And then 2 days later, we get this unemployment report where we've gone up to 4.3% unemployment, up from 4.1%. And this marks a pretty key measure where unemployment has gone up more than 0.5% since its lowest point. And many people you'll see on the news will start to talk about the Sahm rule, which is basically just an economic rule that some economists made up. But it has basically, looking back in history, when unemployment has hit its lowest point and started to move back up over 0.5%, typically a recession comes in the near term, number of months ahead. So a recession would mean unemployment's picking up, and the Federal Reserve's dual mandate says that they need to protect employment and try to, encourage the economy to continue to drive new jobs, because if a lot of people are going out of work, that's really bad for our gross domestic product. So let's take a look at the charts as we close out the week. As we finish the week, the 10-year Treasury has dropped 17 basis points, a significant drop to 3.82%. This is not quite at the end of trading on Friday, but mortgage-backed securities, these are the actual mortgages. When investors purchase those mortgages, the price that they pay, if the price is going up, like we see today, prices are up, that means that the consumer's interest rate is going down because the investor is paying more. But just for simplicity here, we're going to highlight the 10-year Treasury as a way to keep track of overall interest rates, and we're going to look at some trends. So as we see the trend here, today, this is a significant drop. You can see over the last 3 months that we haven't had any day, whether it goes up or down, as significant as today, but most significantly is the long term. So let's take a little bit of a step back. As we take the step back, interest rates have not been this low in the last 6 months. So we're going to have to go back a little bit further to see this, what's called a Fibonacci retracement level. This is the 0% retracement. This is where we're trying to get back to. And if we can get below this, which after this news today, I'm not sure that it's going to, immediately, you can see, what happens with interest rates is they will come through trends. Well, they'll go down, then they'll go up a little bit. But we can see that since April 25th, the trend has been down with some ups along the way. And this has been, situations for us where we've had to encourage our clients to lock in. But then, we don't know what the future holds. We don't know when it'll go up or to what level. And when we see the 1 year look back, we can see that the last time we've got to this level was at the very end of 2023, briefly tried to get close to it in February. And then for most of the first quarter of this year, we were on that uptrend as far as interest rates through April. And now as we start the back half of the year, we're really hoping for a downward trend in interest rates to continue. So wishing everybody a great weekend. If you have any questions, feel free to reach out to our Mortgage Insider group or contact your FresYes representative.